If you knew all the tips and tricks, all the features of every mortgage in Canada, how would you structure your mortgage? If you've been to my channel before, you already know that I'm a nationally award-winning mortgage broker. And so in today's video, I'm going to be sharing with you how I have my own personal mortgage set up on my primary residence. And I'm not just going to share with you how I have myself set up, I'm going to share with you why I've done the things that I've chosen to do. Now, before I start, this isn't intended to be some kind of legal or accounting advice. In fact, for that matter, it's not even meant to be mortgage advice, because the truth is there is no such thing as a one-size-fits-all. And while this might work for me, it may not necessarily work for you. In order to know that properly, we would have to have a one-on-one consultation where I could actually make sure that this mortgage advice was actually fitting your needs. And in order to have that video call with me, that one-on-one chat, you can go ahead and use the links in the descriptions of this video to book a time directly into my calendar. The truth is, the mortgage that I have is one of the most complex mortgages that you can have in Canada, and it's complex in necessity. It's complex because it needs to be in order to do all the things that I want it to do. By extension, though, that means it's not a fit for everyone. In the hands of someone who knows what they're doing with it, it's going to be a great financial product, but it's also going to have the capacity to put you in a very, very bad financial situation if you don't have certain fiscal controls in place. The analogy that I typically give on this is that this mortgage is like a tool. It's like fire. You have the ability to cook your food with it, but you also have the ability to burn your house down when used improperly. Okay, so enough disclaimers. The mortgage that I have is called a Manu1. It's the Manulife's version of a CLP, a combined loan product, which means that it's a combination of both a home equity line of credit, a HELOC, and a fixed rate sub-account, all tied into one. This means that the mortgage that I have isn't some standard residential mortgage. Instead, it's actually a mortgage that's comprised of multiple different parts, and each part is unique in its own right. Now, before I get into all of the complexities of the tracking accounts, the main account, the sub-accounts, and all of that other fancy stuff, let's talk about some of the basics that I think people either ignore completely or get wrong when selecting their own mortgages. And some of that stuff is built into this mortgage, which is super relevant. And before I get into that, I have to provide at least a little context, because you got to remember that depending on when you're watching this video, the economic environment that you're in might make these recommendations seem a little bit odd. When I got this existing mortgage that I have now, it was sometime at the beginning of 2021, and we were still well within the pandemic rates. And I was one of the few smart people who decided that he was going to lock in his rate for a longer period of time. So while I definitely have parts of my mortgage that are locked in for a longer period of time using those low pandemic rates, emulating that in the economic environment that you're in while you're watching this might not make a ton of sense, especially if there's a more favorable mortgage composition out there, which there may be. Given all of that context, one of the things that was obviously important to me was having portability and assumability. So portability is the ability to take the mortgage with you in the event that you were to move, and that really accomplishes two goals. So the first is that you try to avoid or reduce your penalty output, because the number one reason why people are paying penalties is they are selling their existing place, breaking their existing mortgage contract, and getting a new mortgage for their new place. But with porting, that allows you to take the mortgage with you, so you're not actually breaking the contract. Yes, you'll have a porting fee, but you're not going to have to pay the penalty that goes with it. Further to that though, because I had also locked in those pandemic low rates, I want to be able to take that rate with me in the event that I move and continue to receive the benefit even if I'm in a new house, and porting allows you to do that. But porting isn't always a perfect science. Maybe the possession dates don't line up, the sale of my existing house with the purchase of my new house. Or maybe the lender doesn't like the new type of property that I'm trying to buy, in which case they're going to decline the port. That's why I wanted assumability also built in, so that if I was to sell my place, the buyer could assume the responsibility of my mortgage contract, taking over that low pandemic rate and the structure of the mortgage that I had, thereby passing on some of that value in the sale of my house. But let's say for whatever reason, portability and assumability didn't end up being viable options in whatever environment I was in. In that case, I definitely want to know how my penalties are being calculated. And this is probably the number one mistake that people make, and probably a lot of people are making it right now since rates are higher. It is very common for fixed rate mortgage contracts to have two different types of penalty calculations. In fact, some of them might even have 3 or 4, depending on the type of contract that you signed. But the most common are 3 months interest, which is the interest portion of that payment times 3. It's nice and low, it's nice and small. And then there's the interest rate differential. But in the fixed rate contract, there's the three words that make the banks the most money ever, whichever is greatest. And so it's great that you know how 3 months interest is calculated, but if you're going to sign a contract, you better sure as hell know how that IRD, that interest rate differential, is also calculated.
Sign it! Sign it!
So, tell me, what happens now?
And I think here's where some banks get a little bit clever. I don't know if they intended to be nefarious or if they just don't know better, but a lot of times when these lenders are communicating to their own clients that these calculations do exist, they'll say, well, it's all the same. It doesn't matter about all the different types of mortgage products that exist out there. All of them are going to have 3 months interest and all of them are going to have this IRD penalty calculation. And while that is true, that all of them will have an IRD, how that interest rate differential penalty calculation is calculated can be fundamentally different. And so one of the things that I have in my mortgage is called the monoline calculation of the interest rate differential. And I'm not going to get into the complexities of how those mortgage penalties are calculated in this video. I've got a whole separate video that I'll make sure to link in the description so that you can go check out for yourself. But in that video, I go and I describe all the different types of penalty calculations that exist and some of the fundamental differences that you may want to avoid when signing your own contract. But for the purposes of my own mortgage, I do have that monoline calculation of the interest rate differential, which if you ever want to sound cool at a party, you just have to say that and everyone will just swoon over you. Monoline calculation of the interest rate differential. What it means though is that if I ever go to calculate my penalty, it will be the lowest that it ever possibly could have been. And ultimately, if I find myself in a situation where I need to pay a penalty, that's the outcome that I want. Now, on top of all of that, this particular mortgage has fantastic prepayment options, allowing me to prepay as much as 20% down of my original mortgage balance on my sub-accounts, and we'll get into that technicality in a second. But I can pay as much as 20% down penalty-free every single year, which means if I really wanted to get aggressive with my payments, I could pay off my mortgage in full in 4.2 to 4.6 years. I'm not going to do that, but I could. I could if I wanted. And that basically covers the basic portion of my mortgage. From here on out, things start to get a lot more complicated and a lot more nuanced. My mortgage is comprised of 3 different parts: a main account, a sub-account 1, and a sub-account 2, and they're all unique in its own way. And while I'm not going to share with you the exact numbers that I have for my own particular situation, I will put on the screen some examples so that you can follow along. The main account that I have is essentially a home equity line of credit, although it's a little bit more advanced than that, and we'll get into some of those technicalities in a bit. But essentially it operates like a line of credit tied to my home, allowing me to take money against it and put money on it, take money against it and put money on it. And that way it's a revolving line. And to that point, I only ever pay interest on the balance that I'm holding, not the limit, but the balance. So I could have a $100,000 limit, but if the balance that I'm holding on that is 0, then I'm not paying any interest on that particular account. And let's say I was holding a balance on this particular account, I would only ever be paying interest-only payments. And this particular portion of my mortgage is actually variable, meaning it's tied to the bank's prime rate. We're going to come back to that main account in a bit. Now, in addition to that main account, I also have 2 sub-accounts, sub-account 1 and sub-account 2. And this is the fixed rate portion of the mortgage that I have. Now, these sub-accounts are really quite structured very, very similarly, but they behave fundamentally different. Let me explain. Sub-account 1 is my non-readvanceable fixed rate mortgage, meaning it behaves and operates like a standard residential mortgage. So as I pay it down, it becomes nothing and it gets paid off. It is like sub-account 2 in the sense that its term, its rate, and its amortization is all equal. But sub-account 2 differs because it is the readvanceable sub-account. So as I pay down that balance, the limit in my main account, the limit in my home equity line of credit, actually grows by that same amount. So if I pay $10,000 against my sub-account 2, my home equity line of credit limit also increases by that same $10,000. In other words, I don't need to be sitting on cash for an emergency because I have my home equity line of credit that I can pull from, my main account that I can pull from at any time. So anytime I have extra cash, I have the ability to make prepayments against my sub-account 2, knowing that if I ever need the money to drop back out, I could do so on my main account. That's one of the things that makes this so special. While other people are out there putting aside emergency funds or safety nets in cash in a savings account that essentially doesn't pay them anything in interest, I can go ahead and put my money against my mortgage, saving me interest until I need it. But let's go one step further, because there's actually more that can be done based on how this mortgage is set up. For instance, the main account, the home equity line of credit, can actually be broken down into different tracking accounts, allowing you to borrow against your home equity line of credit for the purposes of investing. And tracking that specific interest to that investment is going to be hella easy, and your accountant is going to love you for it. But what this means is that we can borrow against our house for the purpose of investing and turn that interest into a tax-deductible expense. This means that if you have extra money that you're looking to invest, let's say $20,000, and you're clever, you can take that $20,000 and you can pay down your sub account too with it. In doing so, you're paying down the fixed interest rate that you're paying that is not tax deductible. And then, because your home equity line of credit limit is now increased by $20,000, you can borrow against that, setting up a tracking account specifically for that investment and investing using that money. Meaning effectively what you've done is you've taken interest that you're paying on $20,000 worth of money that is a non-tax deductible expense and turning it into interest that is tax deductible. But let's go one step further, because that main account can actually also be used as a regular banking account. There are some advantages to that. A regular bank account is responsible for all of your monthly cash inflows and all of your monthly cash outflows, all of the money coming in and out of your given account. So when you make money, you earn income, you earn a salary, it gets deposited into that account. And then from there, you pay your visa, your mortgage, your rent, your credit cards, your student loans, and anything else that you have to pay in that given month. And hopefully, if you've done things right, you've made more money than you've spent, and there's a little bit of money left in that account at the end of the month. What the Manu 1 does though is it takes that same idea and it flips it on its head a bit. So when you earn an income or you earn a salary, yes, it gets deposited into your Manu 1 account. And then from there, you pay your credit cards, your visas, your mortgage, your student loans, your car loans, any of those cash outflows that you have. And of course, at the end of the month, hopefully you have made more than you've spent, and so you have a little bit of money in that account at the end of the month. But what's different here is that the moment your income gets applied into that main account, you stop paying interest on that portion of the mortgage. And it's only once your visas or your student loans or your car loans get added back into there that you start paying interest again on that money. Meaning that while your income is sitting there not being used for those other things, it is being used to save you interest on your mortgage. You're basically saving interest every single day for every single dollar that is not currently being used. So the timing of your payments also start to matter. Now, out of all of the things that I've talked about already, one of the things that matters most to me as both a husband and a father of 2 children is, what if something happens to me? What happens then? And that's one of the things that I like about the Manu 1 is their right to survivorship, meaning that if I die, the home equity line of credit, the mortgage, it all stays intact. It doesn't get frozen or get shut down the moment something happens to me. And that's unlike almost all other home equity lines of credit out there. Even some mortgages behave that way. So at a time when you need the home equity line of credit most, it gets frozen. So you can't use it for things like funeral proceedings. You can't use it for bereavement leave as you're trying to apply for other insurance and everything else. No, it gets frozen immediately. And that's something that the Manulife 1 doesn't do. They basically say, hey, when you need that home equity line of credit most, we're gonna keep it open for you. Essentially, this means that the Manulife 1 will be there for me and my family whenever we need it. And it's both stable and flexible, a combination that is obviously super important. But like I said, this product isn't for everyone, and depending on the economic environment that you're in, the composition of this product, maybe it isn't 2 fixed rate sub accounts that you need. There's other ways of structuring this mortgage that might be more relevant or effective for you depending on your situation. So like I said before, if you're looking for a conversation on that, make sure you use the link in the description below and book a time to chat with me one-on-one. And if you haven't done so already, make sure you subscribe to this channel, hit the little bell notification so that you're alerted when new videos come out, and make sure you like and share this video.
I'm about to bomb this whole motherfucking plane.